Welcome to This Explainer. Okay, we're jumping right in today because we are unpacking the ultimate truth teller of a business's financial health, the cash flow statement. It's a document that's often misunderstood, honestly, sometimes a little feared, but it is absolutely essential for knowing what's actually happening inside a company's bank account.
So think about this for a second. Why do profitable businesses fail? It's kind of a shocking reality, but the absolute biggest reason small businesses go bankrupt is poor cash flow management. It's not a lack of profitability. You can be generating massive sales on paper, but without the physical cash available to pay your staff, your suppliers, or your lenders, the business is just going to choke. The phrase cash is king isn't just some catchy business slogan. It's literally a survival mechanism.
And that brings us to what we call the profit illusion. Under the accrual basis of accounting, which, by the way, is the global standard, your income statement is actually lying to you about your physical bank balance. Accrual accounting recognizes revenue when it's earned, not when the cash is actually received. And it records expenses when they're incurred, not when the cash actually leaves the building. So profit? Profit is really just a theoretical score. Cash, on the other hand, is the hard, cold reality of what you have in the bank today.
To help bridge the gap between theory and reality, here is our roadmap for today. 1. The profit illusion. 2. Anatomy of cash flows. 3. Investing and financing. 4. Operating activities unpacked. 5. The indirect method shortcut. And 6. The master reconciler. Section 1. The profit illusion. Accrual accounting versus reality. Let's start by unpacking why cash really is king and why we desperately need a financial statement dedicated entirely to tracking it.
Section 2. Anatomy of cash flows, structuring the statement. Because the income statement can't tell us our actual cash position, we turn to the hero of our explainer, the cash flow statement format itself.
If you look at a standard layout like this one provided by Harper College, the goal is actually incredibly straightforward. We're just taking our starting cash balance and we're explaining exactly how and why it moved to become our ending cash balance over a specific period of time. It summarizes every single dollar that flowed in and every dollar that flowed out. But to do this without creating total chaos, we have to categorize every single cash movement into 3 big buckets. And you can easily remember them using the acronym OIF. That's operating, investing, and financing. Every single transaction a business makes goes into one of these 3 categories.
Section 3. Investing and financing, non-core activities. Before we tackle the daily, operational grind of a business, let's look at the cash flows that sit outside of those core operations. Notice how cleanly we can separate these non-core moves. Investing activities, they relate to long-term assets. So, for example, if a fictional Quidditch team, let's say the Chudley Cannons, buys a batch of new Nimbus 2001 broomsticks for $70,000, that is an investing cash outflow because brooms are long-term assets for them. On the other side, financing activities are all about how a business actually funds itself. So raising a $20,000 long-term bank loan from Gringotts, that's a financing cash inflow. Paying out dividends to the team's owners, that's a financing cash outflow. Section 4. Operating activities unpacked, the core engine. Now we move right to the heart of the business, the cash generated or consumed by our principal revenue-generating activities. What's really fascinating here is that while the investing and financing sections are always calculated the exact same way, there are actually 2 entirely different ways to calculate operating activities. You've got the direct method and the indirect method. The direct method is very literal. It just lists all the cash received from customers minus the cash paid to suppliers and employees. It is super easy to read. But here's the crucial point. While investors absolutely love that intuitive, direct cash basis approach, we really have to learn the indirect method. Why? Because tracking every single individual cash transaction is incredibly expensive and time-consuming for major corporations. So the indirect method has essentially become the dominant industry standard shortcut. Section 5. The indirect method shortcut, reconciling reality. Let's dive right into the mechanics of this famous indirect shortcut and see how it transforms an accrual net income back into a pure physical cash figure. This indirect method is basically a 3-step procedure. We start at the top with the theoretical net profit from our income statement. Then we just work backwards. We strip away the accounting rules by first adding back non-cash expenses, and then finally adjusting for the cash that's trapped or freed up in our daily working capital. Step 2 requires us to add back things like depreciation. Why do we do that? Well, depreciation is basically a phantom expense on the income statement. It's a handy way to allocate the cost of a long-term asset over its useful life to legally reduce your taxes, sure, but it doesn't represent actual cash leaving the bank account this year. If you claim $20,000 in depreciation, your net profit drops by 20 grand, but your cash balance didn't. So we've got to add that $20,000 right back to our profit figure. Moving to step 3, we adjust for working capital. And working capital is simply the difference between short-term current assets, think inventory and receivables, and short-term current liabilities, like accounts payable. This right here is where most profitable companies literally bleed cash. This matrix from Texas State University acts as our ultimate cheat sheet for calculating these working capital adjustments. But, rather than just memorizing a table blindly, let's understand the actual logic behind it, because it is brilliant once it clicks. To make this super intuitive, just remember this rule of thumb. If a current asset goes up, your cash goes down. Think about it. If you buy a massive warehouse full of inventory, your asset column goes way up, but your cash is now trapped in cardboard boxes. It's gone from your bank. Conversely, if a liability goes up, your cash effectively goes up. If you delay paying your suppliers, your accounts payable liability increases. Sure, but you've preserved that cash safely in your own bank account for a little bit longer. Section 6, the Master Reconciler, bringing it all together. Okay, let's tie all of these adjustments together and see how this statement performs its ultimate magic trick in the real world. Let's look at a quick case study of a fictional dating app called Tumble. On paper, their income statement boasts a massive net profit of $9.65 million. Looks great, right? But when we apply the indirect method, a completely different story emerges. We add back $850,000 in non-cash depreciation, but then we notice their accounts receivable skyrocketed by $5.2 million. That's money they earned, but they haven't actually collected it yet. It's totally trapped. So after making all the working capital adjustments, Tumble realizes its true cash engine is generating just $4.85 million. Their physical operating cash is essentially half of what their profit score claims. And that brings us to the grand finale, the final formula. We take that operating cash flow we just calculated, we add the cash from investing activities, and we add the cash from financing activities. When we sum the cash flows from these 3 OIF categories, we finally arrive at our ultimate destination, the net change in cash. Returning to our Tumble example, after adding their operating, investing, and financing flows, we get an exact figure, $3,105,000. Now, this number isn't just some random output. It perfectly bridges the gap between the exact cash balance reported on last year's balance sheet and the exact cash balance reported on this year's balance sheet. It literally reconciles reality down to the penny. I really hope this explainer has illuminated exactly why profit is just an accounting theory, but cash is undeniable reality. The accrual system might lie to you, but the cash flow statement, it will always tell you the truth. Which leaves us with one absolutely critical question. If you ran your own business's numbers through this rigorous indirect method today, what would the cash flow statement reveal about your true capacity to survive? Keep learning, keep questioning, and we'll see you in the next one.